Hello and welcome to the next level of learning to trade with Forex. This intermediate course will focus on giving you trading knowledge in major currency pairs and metals. This video explains the fundamentals of the Forex market, major currency pairs, their symbols along with their nicknames as referred to by traders, and the favoured groups of currency pairs for trading that are liquid and active in the Forex market. We also briefly discuss some of the electronically traded metals and have a brief look at the two primary approaches to analysing currency markets, fundamental and technical analysis. We'll start with the list of major currencies and their respective designation in the Forex market. These are the 8 major currencies and their respective codes that make up the majority of trade in the currency market. The US dollar, designated as USD, the euro is coded as EUR, the Japanese yen as JPY, the Great British Pound as GBP, the Swiss franc as CHF, the Canadian dollar as CAD, the Australian dollar as AUD, and the New Zealand dollar as NZD. In the Forex market, a currency pair is the relative value of a currency unit against the unit of another currency. There are 7 currency pairs known as majors or major currency pairs. These are each of the major currencies when paired with the US dollar. Euro versus the US dollar versus the Japanese yen, British pound versus the US dollar versus the Swiss franc, US dollar versus the Canadian dollar, Australia dollar versus the US dollar, New Zealand dollar versus the US dollar. As major currency pairs are paired with the US dollar, any economic changes in the US could affect all the major currency pairs. Hence, economic developments in the US tend to generate more volatility in the Forex market. Approximately 85% of all currency transactions involve these major currencies, making them the most liquid in the Forex market. As major currency pairs contribute the maximum of all transactions, they have a larger number of participants. The spread between major currency pairs, the difference between the bid and the ask price, tends to be lesser than the spread between minor currency pairs. Major currency pairs are further divided into the majors and the commodity pairs. The majors consist of Euro US dollar, Japanese yen, Great British Pound US dollar, Swiss franc. The 3 commodity pairs consist of major currencies that possess large amounts of commodities and natural resources and which therefore depend heavily on these exports for income. These commodity pairs are the US dollar, Canadian dollar, Australian dollar, US dollar, and New Zealand dollar, US dollar. These pairs are highly correlated to changes in commodity prices. For example, Canada has a large mining industry and are heavily dependent on the US for their export of gold, nickel, uranium and lead. The same applies to Australia, which is also an export-oriented country. In this instance, China is the largest consumer for their exports, most notably of wool, iron ore, gold, coal and liquefied natural gas. As such, changes within the commodity segments which these countries export and economic changes from their major export partners can have significant effect on their economic welfare and currency strength. Major currency pairs are sometimes also referred to by their nicknames. Euro US dollar is also referred to as fibre, US dollar Japanese yen as yen or ninja, Great British Pound US dollar as sterling or cable, US dollar Swiss franc as Swissy, US dollar Canadian dollar as loonie, Australian dollar US dollar as Aussie, and New Zealand dollar US dollar as Kiwi. Moving on to metals trading. In addition to currency pairs, metals have also been one of the most traded commodities. Historically, people used to store gold and silver in order to safeguard against currency risk, and this trend has started gaining momentum in electronic trading as well. Why invest in metals? Gold and silver are probably the world's best known and the most widely traded precious metals. This trend of trading metals has spread to various other metals, including copper, nickel, lead and zinc, which can be hedged against their future price. Where to buy and sell? Metals are traded actively worldwide 24 hours a day, and most of the transactions are conducted electronically. Various market participants like banks, brokers, investment companies, jewelers, industrialists, and private individuals are the active players in this market. One of the ways to trade metals is to manage a contract for difference, abbreviated as CFD, where one can bear the benefits and limitations of owning the underlying without physically owning it. In a CFD, the seller will pay the buyer the difference between the current value of an asset and its value at contract time. If the difference is negative, then the buyer pays the seller instead. Due to increased participation from traders and investors, it has become easier to find many buyers and sellers for their CFD settlement, which adds to the benefits of trading in CFDs. Even though metals are CFDs, they are still traded at the spot rate and are broken down to ounces. A trading lot of gold, XAU, consists of 100 ounces, while that of silver, XAG, consists of 500 ounces. On the MetaTrader trading platform, metals are shown the same way as currency pairs, XAU US dollar and XAG US dollar. The quoted price shown in the navigator menu stands for the price of 1 ounce of the metal in US dollars. Types of analysis. There are basically two primary approaches to analysing the Forex market to help determine what is likely to happen next. They are fundamental analysis and technical analysis. Fundamental analysis studies the causes of market movements and gets to the root of the forces that drive the supply and demand of currencies based upon economic, political, environmental, and other relevant factors. Fundamental analysis mainly focuses on the overall state of the economy and has a long-term outlook giving a general direction of the market. So whilst fundamental analysts focus on investment, which is longer term, technical analysts focus on short-term trading. For example, on May 7th, the Reserve Bank of Australia cut the benchmark interest rate by 25 BPS to a record low of 2.75% in order to bolster economic growth. Fundamentally, this event indicates depreciation in the Australian currency against other counterparts. After the news was released at 2 p.m. by the RBA, there was initially volatility in the currency as the market reacted to Australia's economic outlook and the currency value lowered. Technical analysis is all about the saying that history repeats itself, and thus technical analysis is the art of using history to predict the future. Technical analysts look for similar patterns that have happened in the past and base trading practice under the belief that prices will make the same movements as they did in the past. Technical traders are those who use technical analysis and focus purely on price action, or more specifically on historical price action, to try and determine what is going to happen with future price actions. As a general rule, technical traders tend to be more short-term in nature in terms of the time of the trades. We'll take an example of the Australian dollar US dollar daily chart. We know that the pair sustained the breakdown of an ascending trend line near 1.0248 on May 7th, which signals that selling pressure will continue, but the pair is still left to break 1.0234, a 50% retracement level of its 1.1079 to 0.9387 downfall. If it breaks that level and sustains the breakdown, technically the next support should be 1.0033, a 38.2% retracement level, and 0.9786, a 23.6% retracement level. If on May 7th the pair keeps on trading below the 1.0234 level, an investor should take a sell position. In reality, on May 10th, the pair breached 1.0033, a 38.2% retracement level, and a 23.6% retracement level of 0.9786 was reached on May 17th. Fundamentally, the Australian dollar depreciated due to an interest rate cut, which fueled the economy with a higher money supply. Technical analysis offered the point of entry below 1.0234 level and subsequent points of exits at 38.2% and 23.6% retracement levels. This was a brief overview of the two primary approaches of analysing currency markets. Fundamental and technical analysis will be covered in more detail in the following tutorials.